the fixed income strategy for last year was pretty simple. Avoid things that the government has guaranteed and be in things that corporations have guaranteed. So if you look at the bond market returns last year, the Barclays aggregate index, that's the bogey, was up 6.5%. And then if you look at the corporate side of the equation, high yield was up 15. Emerging market bonds actually did well last year. They were up 13. Corporates themselves were up 9. And then everything else that was guaranteed by the U.S. government did well, but it didn't do as well. So you can see treasuries and municipals lagged the benchmark a little bit. So let's take a look at how our portfolios did. Right now, we've got 65% allocated to what I'll call multi-sector, which is a euphemism for corporates and international debt. That portion of the portfolio was up 9.4%. Our intermediate term portion, which was bill gross, basically, was up 8.5%. Then if you look at our high yield portion, which is a very conservative high yield manager that we've held for quite a long time, was up 12.5%. So the bogey, the Barclays Ag, was up 6.5%, and then our fixed income portfolio was up 10%, gross 9.4% net of fees. Thank you. Winning on the offensive and the defensive side of the ball, kind of hard to do. So this was a great year. Really grateful for that. So let's take a look at the longer term returns. And it's important, too, to frame the way that we view returns. This is really important. The market in our business model is a means to an end, not an end of itself. And so the ambition is not to be on the cover of the Wall Street Journal 30 years from now as the genius who compounded money higher than anybody else on the planet. There will be somebody who does that, and they'll get there because they took a lot of risk, right? What we're trying to accomplish in our model is if we can outperform the markets marginally over time, then all of the financial plans will arrive ahead of schedule. That's the goal. The goal is for you all to be on the cover of the Wall Street Journal as people who successfully completed your financial plans, not for us to be on the cover because we blew the markets off. So with that perspective, we have been fortunate. On the equity side of the house, we've been compounding since mid-02. Returns I can be held personally accountable for at about 17.5% versus the S&P at a little less than 5%. On the fixed income side, we got bearish on the government in 08, and the government bonds actually worked out. We're getting that margin back now. So we've been compounding at 4.6 over time, and the Barclays Ag's been at about 5.4. That's inverted this year, where the Barclays Ag is actually negative and we're actually positive, which is a good litmus test for what you do in a rising rate environment. So we're catching up here, but overall, in proportion, the plans are ahead of schedule.